Welcome to the Money and Meaning Show with Jeff Bernier, a show dedicated to helping you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most.
Well, hello and welcome to the Money and Meaning Show. My name is Jeff Bernier. I am so glad you decided to spend a few minutes with me today as I present another Perspectives broadcast, and gives me an opportunity to share some things that I've been thinking about or reading about, or quite frankly, things that I find interesting that you might find helpful. So that's really the purpose of the Perspectives versions of these shows. And, you know, the whole theme and the idea behind the Money and Meaning Show, not unlike my book, The Money and Meaning Journey, it's really about how do we get clear on what matters and how can we use wealth management or financial planning or investment management, the broader wealth management ecosystem or planning, to create the capacity to go do what we're called to do. So that's really the big idea on these shows. The Perspectives versions, I just am usually doing more wealth management type of topics on things I'm reading or thinking about, or things that are relevant to the way we're serving clients. So I hope you'll find today's episode helpful. This is an annual thought process, what I'm going to present today, because it happens every year about this time. And what happens every year about this time is we get market forecast. All the major investment firms and banks and many wealth management firms put out their market forecast. And what I want to do today, and again, I've done this in the past, is just talk about how useless they are or how unimportant they are. They're hard not to look at and hard not to read. It's kind of like, you know, when you're driving and you see an automobile accident over in the southbound lane and you're going north, it's hard not to look over there and pay attention to it. And that's the way some of these market forecasts are, because I think psychologically we want to control the future and we want to think we have some control over the future. And clearly we have control over some aspects of our activities, but much of what's being forecast in the time frames that it's being forecast is just a waste of time in terms of getting our attention. But it doesn't stop us from doing it as an industry, and it doesn't stop the banks. And so there were a couple of articles related to this that I thought were pretty good that came across my desk recently. The first one was from Bob Seawright, and he writes a really good blog called The Better Letter. The most recent one that he put out, he basically called Forecasting Follies. He goes through a number of ideas, not just in finance, about how oftentimes we're overconfident in our forecast, even in the light of being really, really wrong. But I just want to highlight a couple of the things related to these market forecasts. And the first one is there are no good market forecasters. Someone once said if there was a market forecaster hall of fame, it would be empty, because there just aren't many good market forecasters. As a matter of fact, some studies have been done that look at past market forecast, and there's less than a 50% hit rate. I mean, you could have just as well flipped a coin. And on average, according to Bob's article, the median Wall Street forecast from 2000 to 2003 missed the target by an astonishing 13.8 percentage points annually. So they're just not very good. Not only that, they revise them constantly. 2025 was a great example of that, as all the major firms put out their forecast. Then, of course, in April, we had Liberation Day and the tariffs announcement, and markets went down significantly, right at bear market territory fairly quickly. And then all the banks and all the investment firms came out with new forecasts, adjusted new forecast. And then 3 or 4 months later, it turns out the market adjusted to some of the news, and they came out with yet again new market forecast. So they're just not terribly helpful. He quoted the CXO advisory group, and they set out to determine how useful these expert forecasts were And they looked at 6,584 forecasts from 2005 to 2012 from 68 supposed gurus. And as I mentioned before, they found their accuracy was worse than a coin flip, just under 47%. So it's just not all that helpful, and a good reason why the best investors in history, like Warren Buffett or Peter Lynch or Seth Klarman, have avoided trying to forecast the future. So the making of long-term plans for an uncertain future based on incomplete information and shifting variables is very difficult. So it certainly makes sense to plan, but it doesn't make a lot of sense to predict, certainly in these time horizons that they're doing, which is basically one calendar year. Another one of a similar vein, several months ago, I had Rubin Miller on from Peltoma Capital Partners. And Rubin, a really smart guy. I like him a lot. I think he's a really good guy, and I think he serves his clients incredibly well. He has some strong opinions, and he's very pithy about it. But he wrote a really good piece a couple weeks ago with his 2026 market forecast. And this is him basically sarcastically or with tongue in cheek providing a market forecast, but making fun of the whole exercise, because when he makes a forecast for 2026 for most risk asset classes, his table where he shows his 26 market forecast, they all say none. So there is no market forecast for stocks and international stocks and emerging market stocks and so forth. And his point of that is, in a 1-year time horizon, it's ridiculous. And so he doesn't make them, nor do we in our firm. He does, however, have return expectations in things like short-term treasuries and short-term debt instruments, which are a little bit more forecastable in the short run. So, for instance, if you bought a 1-year treasury bill, you can be pretty certain on what you're likely to get over the next 12 months. Some short-term fixed income assets, he does actually have a market forecast. And again, he states the same kind of things before. We're talking about noisy risk assets that it's just impossible to predict over the short period of time. So no forecasting, not necessary to do short-term forecasting, even though, if we produced one, it might create some clicks on a blog because, again, we oftentimes can't help ourselves from reading them. It makes no sense to use them in our financial planning or investment process, at least these short-term ones. However, we do need to make long-term expected return assumptions. So we don't do short-term market forecasting, but we must make assumptions about long-term capital market results because those are inputs that we need to do a financial plan to figure out how much do we need to save or invest, or when can we retire and how much can we spend in retirement. So there's a difference, I think, in making these short-term market forecasts versus making long-term expected return assumptions that you can build a financial plan around. And those are still educated guesses. But if I've got a 30-year time horizon instead of a 1-year time horizon, I have a lot more confidence in the base rate. You start with history as the base rate. And we'll talk about why you don't rely just on history here in a minute. But we do need to make some estimates of long-term expected returns. With that, we can be a little bit more confident because over a 10 or 20-year period, return to stocks and return to bonds and return to cash and inflation expectations and things like that are a little bit more stable on a long period of time. So we can be a little bit more confident on that. And the reason all this matters on the expected returns, there's really a couple of reasons it matters. The first one, as I just mentioned, is in inputting in a financial plan to determine how much we need to save or invest or when can we retire and all those factors that we just talked about. But again, these are educated guesses and why it's so important to continue to monitor and update your plan with new realities in terms of, what happened. The second reason they're really important has to do with portfolio construction, because obviously if we've got long-term capital market assumptions, it helps us build portfolios that are reasonable in terms of expected returns and volatility across the different asset classes. The third reason these long-term expected returns, or even more intermediate term, say 5 to 10-year expected return estimates are helpful, is it helps us set our intermediate term expectations. And that's what I want to talk a little bit about now and how you might set those expectations. Because what many people do in setting these expectations, especially in the intermediate term, let's call it the next 10 years, what they'll typically do is they'll extrapolate the past. So they'll say, okay, here's what's happened in the last 10 years or so. Let's assume that's what will happen in the next 10 years. And while the long-term 30 or 40-year return histories might be helpful in setting long-term expectations, we think it's very dangerous to use recent history to extrapolate over the next 5 to 10 years or so. But that's what many people do. And interestingly enough, realized returns are almost the opposite of that. So if we've had a period of higher than expected returns recently, and we extrapolate that out, markets are a bit mean reverting. So we're creating higher expected returns at exactly the time we should probably be a little more cautious. But that's what many people do. A better way, we think, to develop these expectations over the intermediate term, say 5 to 10 years, is to look at the earnings yield, to look at the yields. And when I say yields, I'm not talking about just stocks. I'm talking about bonds and cash and other asset classes as well. The yield, which is the earnings or the profits relative to the prices or the interest that you're being paid on the bonds, is a better predictor of short to intermediate term returns. And it's almost counter-cyclical to how people operate. People, again, extrapolate the past, whereas you and I should be a little bit more measured in our expectations after things have gone really well. And that's certainly relevant today because one of the major earnings yields that you might consider is Robert Shiller created the CAPE ratio, the cyclically adjusted price earnings ratio. And so what it does, it looks at prices divided by the last 10 years normalized earnings. And that has been a pretty good predictor over a 5 to 10 year period of subsequent returns in major asset classes. And the danger with extrapolating these last several years that have been so good and prices are now high is that the CAPE ratio is pointing to really high prices, and rarely have they been as high as they are now, which would suggest lower expected returns going forward in certainly U.S. equities. And so you have to be careful about extrapolating the past. It's not an exact science. These earnings yields are good predictors, but there are periods of time where the earnings yield suggest lower expected returns and realized returns were actually much higher than we expected. You know, the recent past has been pretty good examples of that. And, you know, if the AI innovation is incredible and earnings keep going through the roof, which is hard to imagine that they could be high enough to justify some of the valuations, they could. It's not an exact science here, but it's really important in managing your and my expectations. And it's the way firms like Vanguard do their 5 and 10 year forecasting. It's the way people like AQR and Research Affiliates and others. And what those basically say is we should be a little more cautious in our expectations with certainly U.S. equities in particular because of the low yield that they're currently generating, which is the profits divided by the price. The cyclically adjusted earnings yield, which is just the Shiller PE, you flip it and look at the earnings divided by the price. And again, the yield are low on U.S. equities. And so Vanguard and AQR and Research Affiliates and others that use an earnings yield methodology suggest much lower than recent returns in U.S. equities in particular. So that's my caution as we set expectations for the next 5 to 10 years in planning. So they're important for financial planning inputs, But again, in financial planning, I'm doing a 30-year or 40-year expected return. I'm not near as concerned about the 5 to 10-year number, other than it can help me set expectations with you on what's realistic in these various asset classes. It can also help, as I mentioned, in portfolio construction and how you build and manage portfolios and manage risk. And then finally, as I mentioned, it's helpful in making sure we stay in the game. And when we talk about the recent past, my friend and consultant Larry Swedroe wrote a piece recently, which you can find on Substack and other places, called The Deficit Fueled Market. And he quotes some research, and it's really good peer-reviewed academic literature. And the article's called Financialization: How Fiscal Policy Has Inflated Profits and Equity Valuations, from Chris Brightman and Alex Picard. And again, you can go to Larry's Substack, or you could probably Google Larry Swedroe, The Deficit Fueled Market, and you'll get the article. I'll try to remind you where you can get these other 2 blogs that I mentioned as well here at the end of the show. But again, what this research basically says is in the last 20 years or so, much of the deficit spending from government, basically spending more than they're bringing in the lower interest rates, have fueled capital flows into profits and earnings. And if we have a reversal of those things, if we cut deficit spending or rates go up, that could portend certainly a different environment than we've experienced in the last 20 years. And what's unique about the last 20 years, the U.S. economy didn't used to operate like that. We used to do deficit spending during recessions and low employment to try to prime the pump and cut deficit spending and all this additional capital flowing into the capital markets during expansions and full employment. But now we're doing it over the last 20 years or so all the time, regardless of the economic environment. So the danger here is if there is a shift, it could certainly be problematic for profits and earnings. And we're sort of in a trap because we don't have a choice because of the size of government and a fragile underpinning. So all that is to say is that we just want to manage expectations. Now, when we talk about these expected returns, one thing to note, as I've alluded to before, is there are certain sectors of the opportunity set that are not quite as elevated, that have higher earnings yields currently or lower prices relative to the fundamentals. And one great example that, again, we've talked about a lot is international versus U.S. And the question around U.S. exceptionalism, I know that's a term you may have heard, is it sustainable? So what has happened is U.S. markets have gotten relatively expensive relative to the international markets, and the share of portfolios in U.S. has grown to around 70% of the total world market capitalization. Whereas if you go back to about 1980, it hovered around 50 or 60% of the market capitalization. So right this moment, not only is the earnings yield on U.S. equities low, therefore pretending lower expected returns, most of our money is allocated there in total of investors. So again, there's reasons to consider making sure that we're broadly diversified, and certainly in terms of international exposure. Again, we've talked about that on these Perspectives broadcasts a bit recently. So again, the big takeaway here is we don't do market forecast for a lot of reasons for the short to intermediate term. We do need to make realistic expected long-term returns in order to build sound financial plans. And in the short to intermediate term, we can use things like the earnings yield to say, okay, certain asset classes, we just have to have reasonable expectations on the short to intermediate term. But again, we have to be humble. There's a lot we don't know. So let me just give you the normal takeaways here in terms of how we construct and manage financial plans and portfolios, certainly for my hero, which are people that are either approaching retirement or in retirement and are trying to build resilient portfolios to last over a 20 or 30 year period. But, we got to get through the next 5 or 6 to make it through the next 30. So what I'll call resilient portfolios. And so the overall advice doesn't change that much. We want to stay debt-free, generally in retirement. I guess my only exception to that, if you've got a mortgage with really low interest rates, that might be a really good inflation hedge, but it feels really good to be debt-free in retirement. So we generally encourage that. Obviously, make sure that you can invest for things that you hope goes right, but protect for things that could go wrong. So make sure we have good defense, primarily through insurances and emergency reserves and those kind of things. And that's really the third thing, is make sure we have adequate, safe, liquid resources for short-term needs. And, a couple years worth of anticipated distributions. We've talked a lot about that if you want to look at past shows about, sort of the bucket approach. Number 4, build a long-term portfolio. These long-term risk assets based on your need, ability, and tolerance for risk. And that helps define how much ought to be in growth assets and how much ought to be in more defensive assets. And then when you look at the growth assets, which are generally equity-like investments, make sure you have adequate diversification in terms of U.S. and international, as I mentioned, in terms of factors. Don't have just market exposure. You might want to have some value strategies. You might want to have more profitable companies. You might want to have small companies. So have broad diversification in those. And if appropriate, you might even go even broader diversification into, some more non-traditional types of asset classes if you have the liquidity and the ability to do that. And then finally, just have to be resilient and have a plan B. In closing, I think all of this is interesting. Just ignore the noise around the forecast. Don't get too excited about them, even though you may have to look like the car accident. Don't accept them as that useful or helpful. You do look at earnings yield and expectations for longer term that I think can be helpful as we manage our expectations. And I am an optimist. I feel great about the ability for you to meet your financial goals if we focus on things you and I can control and manage the risk appropriately through being, again, broadly diversified and some of these things that I just illustrated in terms of basic financial planning principles. But at the same time, we do have to be realistic. We do have to be careful about what can go wrong. And again, I did a whole show around Pascal's wager once where we talked a little bit about that. And finally, we just have to be humble about all the things we can't know. So I hope that was helpful in terms of ignoring the forecast, but the importance of managing expectations and using expected returns. You can check out Bob Seawright's blog, The Better Letter. He's on Substack as well, but you could also probably just do a Google search as an example and Bob Seawright, The Better Letter, and you can find his piece on forecasting Follies. You can probably do the same thing as well. Rubin's blog is called Fortunes and Friction. So if you search for that, I'm certain you'll find it. So I hope you found this helpful. If you did, please let us know. Shoot me an email if you have any comments or questions for me at moneyandmeaning@tandemgrowth.com. You can certainly check out past shows at all the major streaming services and would love it if you would share it with a friend, give us a rating. And until next time, have a great day and thanks for joining. Be well.
Thank you for listening to the Money and Meaning Show with Jeff Bernier, a show dedicated to help you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most. We would love to hear from you. If you have any questions or comments on the show, feel free to reach out to us at moneyandmeaning@tandemgrowth.com, or you can find us on the web at www.tandemgrowth.com. Jeff Bernier is the President and Chief Investment Officer at Tandem Growth Financial Advisors, LLC, an SEC-registered investment advisor. This show is a production of Tandem Growth Financial Advisors, LLC. All information discussed is general in nature, is provided for informational purposes only, and should not be construed as specific financial, legal, or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Listeners should not rely on the content of this podcast as the basis for any investment decisions. A professional advisor should be consulted and/or independent due diligence should be conducted before implementing anything discussed in this show. While information presented is believed to be factual and up-to-date, Tandem Growth Financial Advisors, LLC, does not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Tandem Growth Financial Advisors, LLC, does not make any representations or warranties as to the accuracy, timeliness, suitability, completeness, or relevance of any information prepared by any unaffiliated third party, such as guests on the podcast, and takes no responsibility for the same.